International Business Machines Corporation, more commonly known as IBM, also with the stock ticker of IBM, is trading around $147 at the time of recording. Over the past year, they are up 20%, and year to date, they are up 8.6%. So in this video, I'm going to take a closer look with our valuation models, whether or not there are still some more upside to gain, or maybe it's time to sell. So jumping into our stock screener, we can just put in the stock ticker of IBM here, and everything will auto-populate. And I also do have a little bit of a surprise because I have made another valuation model called the Peter Lynch valuation model that I'll also be putting into. So now we have 6 different valuation models. Before we do this, let's just quickly take a look at some of the fundamentals of IBM. And if we look here, the dividend is around 4.47%, which is kind of great. Payout ratio of 74%, 5-year growth rate of just over 3%, a bit on the low side, but with the current high yield as well, this is pretty good overall. I say it's a bit more on the income side rather than a growth stock, but with dividend growth of 23 years, it's looking really, really nice. Currently, they do have a PE non-GAAP forward ratio of 16, which is 40% above its normal, so it could indicate a bit of overvaluation at the current time. Coming down here to the price to book, 5.37. Also don't have it in 5-year average, so can't really tell anything from that. They do have a very, very strong balance sheet, I would say. Also income statement, you can see here the revenue. It has gone down a bit, but if we come down here to the net income, you can see 5.7, 8.7, 9.3, 9.4, sorry, 5.5, 5.7. So they are quite stable still, but only 1.2 in the last trading 12 months. So that is something you need to take into account. If we come into the cash flow statement, you can see cash from operations. They are generating positive cash flow, which is really nice to see because that is what is paying for the dividends. 16.7, 15.2, 14.7, 18.1, 12.7, and then just down in the last trading 12 months to 9. But 3.2 billion, 3.3, 2.2, 2.6, 2, and 1.3. So there are still a lot of free cash flow being generated to actually cover the dividends. And they also do have a strong balance sheet in addition. Jumping back into our stock screener, you can see here that we put in IBM, automates everything else. We do have a lot of the same information here, such as the payout ratio. It differs a little bit. Dividend yield is same as we saw before. And over here, you can see there are a bit of a common information if you don't know the company that well. But let's jump into the different valuation models. And important not to skip ahead here because I'm sharing all of the assumptions I'm making to actually back up the valuation. Jumping into the first one, we do have the Graham's revised valuation model. And you can see here, has auto-populated with a lot of different stuff. We do have the current yield of AAA corporate bonds at 4.12, a growth rate of 9.22, which is taken from the Yahoo Analyst desk. 1G, average yield of AAA corporate bonds, along with the EPS of 1.37, which is kind of low. So it only gets an intrinsic value of $23, which would say at the current price of $147 is quite far away. If we jump into the next one, the discounted cash flow model, you can see here that we do have plotted out the free cash flow growth to kind of get an idea where we are. And if we take a look, it's pretty much around the 0%, a bit under, a bit over, and then pretty high, and then really low. So I took a bit over the average, not that far. I took around half of the growth, and I put in applied growth rate of 4%. So what the discount cash flow model does is that it takes the free cash flow, takes all the growth over the years, and then it kind of averages this together to get an idea. And this is just a guideline for what to put in. Then we take all the future free cash flows, which is all of the cash flow with the assumption of an applied growth rate of 4% per year. Then it discounts that future free cash flow back to a present value and sums all these together. Together with the current cash they have on hand and the total debt, it gets a total equity value. Divided by shares outstanding, we arrive at a fair value of $55, which is a bit over the current price. The next one is the dividend discount model, where we take the different dividend payouts from the different years, apply a growth rate calculation to see how it grows over the years. We then average all this together to get a guideline where to go, and you can see the average growth rate is 1.6, and it's actually only last year there was a bit of a bigger hike. So I have taken a very conservative method and just applied a single growth rate of 1%. Combined with a weighted average cost of capital of 5.76, we do arrive at an intrinsic value of $140, pretty close to the current price. In the multiples valuation, we do compare IBM with some of its peers, and we do have everything automatically loaded in when we punched in the ticker. So you can see here we arrive at a stock price for IBM with a current EPS of 1.37. Should have a stock price of just under $39. The next one is the free cash flow valuation, where we do take the price to free cash flow ratio over the different years. We do then have an average of those. Combine that with the free cash flow per share, we arrive at an intrinsic value of $67. And now the newest addition, the Peter Lynch model, where we do have the growth rate, we do have the dividend yield along with the PE. We can then calculate back to an intrinsic value around $132. And before we get into the summary, if you have come so far, thank you so much for watching this video, and please like the video and subscribe to support the channel. Now let's take a closer look at the summary for IBM, where we do have all the different valuation models here. We do have an average intrinsic value of $92. If we compare that to the current price of $147, we actually have an average current discount of negative 58%, meaning that we would actually have to get the IBM to drop to around $92 for it to be at fair value according to the assumptions and models we have taken here. And even if we apply a margin of safety of, let's say, 10% on top, we would actually have to go down to almost $83 to be an acceptable buy price or a fair value. So if this was a company that I had in my portfolio, I don't have it at the current time. If I had it, I would probably look into selling maybe at least some portion of it and taking some of the profit if you have a profit. Or if you're interested in the company, please go do more research, but this would probably be around my acceptable buy price if I should go into the company. Let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear as well. Thanks again for watching.